The wall has fallen. For months, the entire financial world was told that $65 was the ceiling. They called it the limit, the final line. The level banks would defend with every paper contract they had. But today, Wednesday, December 17th, the market made its choice. And it was decisive. Silver didn't just test $65, it broke through it. Earlier today, price surged to $66.50 before pulling back slightly. Right now, silver is trading near $65.80. And I know what you're thinking as you watch that pullback. Doubt creeps in. You start asking yourself, was that the top? Was this just another fake breakout? Stop. Listen carefully. What we are seeing is not a failure. It's not a crash. It is the most important technical behavior a market can show. This is called a retest. If price had gone straight up without pause, the move would have broken. By pulling back to test the level it just conquered, the market is building support for the next leg higher. The wall at $65 is gone. Now the market is simply asking one question. Can this level hold as the new floor? To understand why silver jumped from $64 to $66.50 so fast this morning, you have to look beneath the chart. You have to understand the plumbing of the market. You have to understand gamma. Gamma is an options term. It measures how quickly a market maker's risk changes as price moves. Think of the market maker as the casino. For months, they sold massive amounts of $65 call options. Bets that silver would rise. As long as silver stayed below $65, those bets expired worthless. The house was winning. But the moment silver crossed $65, everything flipped. Losses didn't rise slowly, they rose exponentially. When price reached around $65.10, risk models inside the banks triggered alarms. To protect themselves from runaway losses, the systems did one thing automatically. They bought silver futures. Not because they wanted silver, because they were forced to hedge. That buying pushed price higher, so to $65.30, then $66. Higher price meant higher risk. Higher risk triggered more forced buying. This is a gamma squeeze. It's a mechanical feedback loop. Pure math, no fundamentals, no supply and demand story. It's the same mechanism that sent GameStop to $400 in 2021. The spike to $66.50 was not enthusiasm. It was algorithmic panic. A vacuum move where sellers disappeared and machines competed to buy. So why did it stop? Because humans stepped in. Traders saw a vertical move and took profits. The forced buying exhausted itself. And price pulled back to reality around $65.80. But here's the key point. The damage was already done. The $65 barrier was broken. The psychological ceiling no longer exists, and the banks now know they can bleed. To an amateur, a drop from $66.50 to $65.80 looks like weakness. To a professional, it looks like confirmation. There's a rule in technical analysis: old resistance becomes new support. For months, $65 was a concrete roof. Today, we broke through it. Now the market is standing on top of it, testing whether it can hold weight. This pullback is not the end of the move. It's the test that decides whether the breakout was real. And now $65.80 is the battlefield. If price holds above $65 into the close, the world receives a message. $65 is no longer a sell level. It becomes a buy level. But there is a risk. If price falls back below $65 and closes near $64, that would be a fake breakout. And fake breakouts often lead to violent sell-offs. That's why this zone matters. This is the buffer. The fight is happening right here. And while everyone is watching the chart, something else is happening quietly in the background. Something much more important. Big money is stepping in. Earlier, we talked about the whale, the mysterious buyer who absorbed roughly $650 million worth of silver around $63. After the spike to $66.50, the obvious question was whether that buyer sold into the move and disappeared. Many assume the rally ended because smart money had already cashed out. But watching the order book tells a very different story. When price pulled back from $66.50 to around $65.80, large block bids appeared almost immediately. Around $65.75, someone stepped in decisively and absorbed the selling. That buyer wasn't chasing price. They were defending a level. This tells us something critical. What was expensive yesterday is now considered cheap. Last week, smart money was comfortable buying at $63. Today, they are willing to pay more, not out of excitement, but out of conviction. This is not the behavior of a short-term trader looking to exit. Speculators sell into strength. This buyer is supporting weakness, quietly placing a floor under the market to prevent price from slipping back below $65. There is only one reason to do that. They understand what comes next. If $65 holds, the next destination is not $66, it's $70 and potentially much higher. Large players don't rush the move. They secure the ground first, establish control, and only then allow price to advance. What we are seeing at $65.80 is not failure. It is consolidation. It is preparation. The gamma squeeze was the spark. The retest is the fuel. But the real fire hasn't started yet, because the true fuel in this market is not retail buyers and not even industrial demand. It is the short sellers, and the largest shorts in silver are not hedge funds. They are the commercial banks. And once those banks are forced to buy back what they sold, the character of this market changes completely. For decades, bullion banks controlled silver by selling paper contracts when price rose and buying them back when price fell. That strategy only worked as long as silver stayed below critical levels. Once price broke above $65, the math turned hostile. Current positioning shows commercial banks holding roughly 80,000 net short contracts. Each contract represents 5,000 ounces, meaning about 400 million ounces of silver sold on paper. Much of that exposure was built at prices between $50 and $55. With silver now near $65.80, every one of those positions is deeply underwater. Short positions don't have a ceiling on losses. At $66.50, risk managers were forced to react. Losses were no longer theoretical. They began to threaten earnings. In the past, banks could cap rallies by adding new shorts. Now, credit limits prevent that. Instead, they must do the opposite, buy to exit. That changes the market's character. Banks are no longer sellers by choice. They become forced buyers. Every dip attracts covering. That's why pullbacks are being absorbed so quickly. The math is brutal. For every $1 increase in silver, commercial shorts lose roughly $400 million. From $60 to the recent highs, losses approach $2.4 billion in a matter of hours, and that assumes they can exit at current prices. In reality, buying that much silver would push price higher, expanding losses further. This is why $65 was the line. Above it, losses become visible. What we are seeing now is not panic, but retreat. Banks are trying to exit quietly, but large buyers are absorbing supply, forcing bids higher. Once this dynamic starts, it doesn't reverse easily. The question now is how we confirm that this buying is truly banks exiting, not new speculation entering. And that answer lies in the data. To know whether banks are truly retreating or simply reloading, we look at open interest. Open interest measures how many contracts remain open in the market. In a typical rally, price and open interest rise together as new positions are added. But a short squeeze behaves differently. When shorts are forced out, price rises, while open interest falls. That drop signals positions are being closed, not created. It means sellers are leaving the market entirely. If silver holds near $65.80 while open interest declines meaningfully, that is confirmation the rally was driven by short covering, not speculation. This is one of the most bullish signals a market can produce because once large, consistent sellers exit, the pressure that capped price disappears. This phase is rarely smooth. Before fully capitulating, banks may attempt one final paper sell-off during thin trading hours to trigger fear. A quick dip towards $64 would not invalidate the move. It would reflect desperation. Unless price breaks below $61.50, the broader structure remains intact. Capitulation is not a single moment, it's a process. And that process creates a powerful bid under the market as forced buyers replace voluntary sellers. While this battle plays out in the futures market, the more important story is unfolding elsewhere, in the physical supply chain. That's where the next phase begins. The price on the screen, around 65.80, no longer reflects the real cost of silver. It reflects the price of a paper contract. In the physical world, that price is already being ignored. Industrial buyers are reporting payments of $70 per ounce or more to secure immediate delivery. For manufacturers, reliability matters more than price. A factory shutdown costs far more than paying a premium for metal. As a result, supply is being pulled directly from refiners and mines, bypassing exchanges entirely. This creates a quiet drain on physical inventory. Futures markets show calm trading while real metal disappears. The disconnect widens without showing up on charts. Retail markets are flashing the same signal. Instead of falling as spot prices rise, premiums are increasing. Dealers know replacing inventory will cost more tomorrow than it did yesterday. Some have widened spreads. Others are offering delayed delivery, signaling tight supply. The result is a false sense of affordability. While the screen says $65.80, the real entry price for physical silver is closer to $75 or $80. When enough buyers refuse to sell at the quoted price, the paper market is forced to adjust. That adjustment rarely happens gradually, it happens suddenly. And when it does, the paper price jumps to meet reality. The next risk emerges when paper holders demand metal and are offered cash instead. Here's where the pressure becomes systemic. Most paper silver holders believe they own metal, but what they actually hold is a promise. And inside nearly every one of those contracts is a clause that matters now. If delivery becomes impossible due to market disruption, settlement can be made in cash. As long as paper and physical prices stay close, this clause stays invisible. But when industrial buyers are paying $70 while the screen shows $65.80, incentives flip. It becomes cheaper to pay out cash at the lower paper price than to source physical silver at the higher real price. At that point, cash settlement isn't a failure. It's a rational decision. Once cash settlement begins, confidence breaks. Investors who expected metal receive dollars instead and rush to the physical market to replace it. That surge of demand hits already tight supply, pushing premiums higher. Higher premiums make further cash settlements more likely. The cycle feeds itself. This is how pricing systems fail. Not in one dramatic moment, but through cascading loss of trust. The $65 breakout was the warning. The inability to secure metal at that price is the confirmation. Paper markets can continue trading numbers, but once belief erodes, those numbers lose authority. When the question shifts from price to delivery, control quietly changes hands. And that's when psychology takes over. At this stage, the biggest threat isn't the banks, it's emotion. Rapid price swings are designed to exhaust patience and force decisions driven by stress rather than logic. Sudden drops followed by sharp recoveries create confusion and doubt, even when the underlying structure remains intact. Expect volatility to increase. Silver can fall several dollars in hours and rebound just as quickly. This isn't disorder, it's pressure. Markets use movement to transfer ownership from those seeking comfort to those willing to tolerate uncertainty. Focusing on short-term charts amplifies fear. Stepping back restores perspective. On higher time frames, the breakout remains intact. Volatility is not a signal that the move is over. It's the cost of participating. Many people anchor to past prices and assume $65 must be expensive because silver once traded much lower. That thinking ignores the reality of currency debasement. Assets don't rise in isolation. They reprice as money loses value. What looks like excess is often just adjustment. This phase tests conviction. Weak hands look for certainty. Strong hands understand that instability is temporary, but structural shifts are not. The next question isn't whether silver will fluctuate. It's how to judge value without letting fear dictate timing. That requires looking beyond today's price. At first glance, $65 silver feels expensive because memory distorts perspective. People remember prices from years ago and assume anything higher must be excess. But price alone is meaningless without context. What matters is purchasing power. In 1980, silver peaked near $50 per ounce. That level shocked the market at the time. But adjusted for inflation, that $50 equals roughly $170 today. Seen through that lens, silver at $65 isn't expensive. It's still deeply discounted relative to its historical purchasing power. This is why comparisons to bubbles miss the point. Stocks are trading at record valuations. Real estate sits near historic extremes. Many assets are priced for perfection. Silver is not. It's emerging from decades of suppression, not from excess speculation. What we're witnessing isn't a blow-off. It's a repricing event. Markets that spend years below fair value don't move higher gently. They reset. And resets are volatile by nature. Understanding this reframes volatility. Sharp moves don't signal danger, they signal transition. The discomfort comes from leaving an artificially controlled range, not from entering a bubble. The real decision ahead isn't about whether silver has upside left. It's about how gains are protected without falling back into the same currency trap that caused this repricing in the first place. That brings us to the final piece. The final mistake most people make is thinking the goal is to sell silver for cash. Cash feels safe, but in an environment like this, it quietly loses value. Experienced holders think differently. They don't sell into currency. They exchange into assets that are undervalued relative to silver. One of the clearest guides is the gold to silver ratio. Today, it takes roughly 70 ounces of silver to buy 1 ounce of gold. Historically, that ratio sits closer to 40 or 50 to 1, and in extreme periods, it has fallen much lower. When that ratio compresses significantly, it signals silver has done its job. That's when swapping silver for gold makes sense without ever touching dollars. The same logic applies to real assets. In past cycles, silver could purchase a home with a fraction of the ounces required today. When those relationships normalize, value has shifted. That's the moment exits become strategic instead of emotional. This reframes the entire move. You're not trading price, you're trading relative value. You're waiting for silver to stop being the undervalued side of the equation. Looking back, the break above $65 will be remembered as a turning point. It marked the end of controlled pricing and the beginning of discovery. Price discovery is uncomfortable, volatile, and noisy. But it's also where real repricing happens. The wall is down, the structure has changed, and from here, the hardest decision isn't predicting what comes next. It's knowing when to do nothing.